Finance is no longer about advice. It's the era of algorithms. The era of egos and gut feelings. From the early days, Wall Street was always run by humans. That's the image of brokers wearing dapper suits, wearing expensive watches with egos the size of an entire country. Classic archetypes like Gordon Gekko or Jordan Belfort. For most of modern financial history, investing through money managers was quite simple. You hired a person. That person would read financial reports, listen to earnings calls, analyze multiples, and then ultimately ignore all of it just because he had a hunch about a certain biotech company. This system was highly poetic. Sometimes they were right. More often they were wrong. But at least it felt very human because there was always a story attached. That could be the management looks very solid, the balance sheet is healthy. Honestly speaking, these things are no different from astrology for men who like to wear cufflinks. For decades, crafting stories was the standard. Markets were inefficient, data moved slowly, and information advantages actually existed. That was the peak of capitalism in the financial market. But then a turning point changed everything. The arrival of the nerds. These were people holding PhDs from Harvard, possessing Math Olympiad medals, and dreams that revolved exclusively around probability distributions. In the late 1980s, they gathered together because they realized a truth. The market is not random at all. It is statistical. Patterns always exist, human behavior repeats, and the very inefficiency of the market opened up opportunities. This was the starting point of quant investing. Instead of asking, is this a good company, the quants asked, with these variables, what is the expected outcome? That was the rise of rules over stories, probabilities over opinions, and math over gut feelings. Quant funds started popping up like acne on a teenager's face. The most infamous was Renaissance Technologies, specifically the Medallion Fund, the most successful investment machine in history that you might not have heard of. Founded by mathematician Jim Simons, the fund operated based on pure mathematical models, no fundamental stock picking, no CNBC interviews, and absolutely no magic. Only math and machine learning. Its efficiency was at an insane level. For over 2 decades, Medallion generated an annualized return of over 60% before fees and 39% after fees. For comparison, Warren Buffett only averaged about 19% per year. If you invested $10,000 at Buffett's return rate for 20 years, you'd have $324,000. But with Medallion, that $10,000 would turn into over $7 million. This system automatically reacted to price fluctuations, order flows, and countless other variables at speeds humans couldn't keep up with. While quant funds became the darlings of the ultra-rich, a crisis was unfolding for everyday investors. The truth is, the number of people who actually have the ability to beat the market by picking their own stocks is extremely rare. By the early 2000s, data proved that active money managers actually did a very poor job. About 90% of them underperformed their benchmark index over the long term. Coupled with exorbitant management fees, investors started asking themselves, why pay extra money only to receive underperformance? This is when index investing stepped in, low cost, passive, and simulating the entire market. Instead of looking for a needle in a haystack, people just bought the whole haystack. At the same time, institutional capital also shifted from active funds to quant funds and private markets. The traditional stock-picking profession was slowly dying. Robo-advisors automating the boring stuff. Even though the active management industry declined, the need for asset allocation, portfolio rebalancing, and tax optimization still remained. That was the context for robo-advisors to appear. To be clear, robo-advisors use algorithms, but they are completely different from quant funds. Quant funds use algorithms to seek outsized returns, alpha, by exploiting microsecond discrepancies. Comparing quant funds to robo-advisors is like comparing a Michelin star chef to canned food. Robo-advisors are merely automated platforms that deliver general market returns at extremely low costs. They do the tedious tasks that previously an advisor would charge you 1% a year just to type into Excel. This appeal is massive. The Wealthfront platform managed only $2 billion 10 years ago, and now it's reached $80 billion. Globally, robo-advisors managed $187 billion in 2017, reached nearly $2.8 trillion in 2023, and are projected to hit the $4.7 trillion mark by 2027. The illusion of personalization. However, robo-advisors have an issue that few mention: fake personalization. They require you to fill out a survey about your age, goals, and investment time horizon. It brings a very thoughtful feeling, but in reality, you aren't designed a separate plan. You are simply sorted into a basket and slotted into a shared portfolio model for thousands of people with the same answers. Robo-advisors aren't some super AI racking their brains to think of a strategy for you. They were simply born to replace the operational role of humans. Lengthy meetings, complicated paperwork, or a guy named Gary using a laser pointer to explain coefficients are now gone. The elimination of the middleman. For decades, financial advisors were paid because they held access to the market and information. Investing back then was like assembling IKEA furniture without an instruction manual. But when the internet appeared, data became free and research tools exploded. Paying someone 1% of your assets every year became absurd. Travel agents didn't disappear because people stopped traveling. They disappeared because booking a ticket no longer required making a phone call. Stockbrokers disappeared because clicking a mouse to buy and sell online is faster than calling Rick on the trading floor. When access becomes free, the middleman will be replaced by technology. Whether it is quant funds replacing active management or robo-advisors replacing traditional advisors, the core nature is the same. When technology touches a stagnant industry, it doesn't create minor tweaks, it forces that entire industry to change from its roots.